Call to order the April 24th meeting of the Santa Barbara City Council Finance Committee. And we have one item on our agenda, which is the quarterly investment report. We don't have anybody in the audience who would like to make any comments about items not on the agenda, so we'll go straight to Mr. Samario. Ms. Nemes.
Good afternoon, Chair Hart, committee members. I am Julie Nemes. I'm the Treasury Manager for the Finance Department, and I'm here today to present the quarterly investment report for the quarter ended March 31st, 2018. I will be going over 4 areas today. The first will be the interest rate environment and some economic factors that impact interest rates. After that, I'll be going over the city's investment strategy and approach. After that, I'll be covering some long-term trends on interest earnings and interest rates and comparing those to some benchmarks. And finally, I'll be covering the city's investment performance and activity for the quarter. So first of all, a little information on the interest rate environment. As we've talked about at some previous quarterly reports, the Federal Reserve has been increasing interest rates over the past couple of years. The first interest rate increase was in December 2015, and they have increased rates 6 times since December 2015 by 0.25%. The current federal funds rate is 1.5 to 1.75%. The most recent increase was in March 2018, so just last month. The Federal Reserve gave a couple reasons for this increase. One of the most significant being that they felt that the economy is performing well. It's pretty strong both in the immediate term and looking out into the long term. They felt that also the most recently enacted tax cuts and the $300 billion of additional government spending would turn out to influence the economy and improve growth as well as increase consumer spending. Also, the unemployment rate continues to be the lowest it has been in over a decade. It's around 4%, and wages are now increasing, which they think will turn into additional consumer spending. And lastly is the inflation rate. The Federal Reserve has set a 2% target for inflation, and inflation has been increasing over the last couple of years. It's been hovering right around that 2% target rate. Oops, sorry. Jumped ahead. Sorry about that. So what does this mean for Treasury yields? Overall, they are still increasing. They have increased since the last quarter, but historically, they're still very low when you compare them to rates prior to 2009. Yields are higher at March 31st compared to December 31st, 2017. The 3-year Treasury shows the largest increase of about 41 basis points, but all of the yields have increased in the double-digit area, anywhere from 20 to 40 basis points. The Federal Reserve at the March meeting did hint at additional plans for 2 additional interest rate hikes in calendar year 2018. They also hinted at additional rate hikes in 2019, anywhere from 2 or 3 additional hikes. And what this means in terms of Treasury yields is that when the Federal Reserve increases rates, it actually does have impacts on Treasury yields. It increases Treasury yields. It also enables the Federal Reserve to cut rates in the future to help stimulate the economy. As the Federal Reserve increase rates beyond this 1%, now we're at 1.5 to 2%. This is less important. In the past, when it was at the lower range and under 1%, that was really important because they could cut rates to help stimulate the economy. They could also cut rates without having to go negative like we'd seen in Europe and Asia. I wanted to just talk a little bit about some economic factors that could impact whether the Federal Reserve will actually do these future rate hikes. What we saw in the first quarter of calendar year 2018 is that there were actually declines in retail consumer spending. However, over the last several years, we've seen that this is maybe a seasonal impact. After the big spending in the holiday season, we often see the first quarter takes a little dip. So this could just be a seasonal variation. We also are not sure what the true impact is going to be of the enacted tax cuts and the $300 billion in additional government spending. So we'll have to wait and see if that truly does translate to more consumer spending and economic growth. There's also some uncertainty related to the trade tariffs. We don't know what the impacts will be to U.S. growth and consumer prices. And lastly, even though we're seeing inflation increase over the recent periods, it really has been inconsistently meeting that 2% target. The most recent March CPI inflation was 2.1%, but that was the first time it went over 2% in about the last 6 months. It's really been more around 1.7, 1.8%. I did want to mention, and we've mentioned this at the last few quarterly reports, that even with these higher rates, it does take several years until we see a material impact on interest earnings for the city. Our portfolio rate has been increasing, but we tend to invest in maturities of 2 to 5 years. So we have to wait until our investments mature and we can reinvest into the market. So it does take time until we see a really significant impact on our interest earnings. This chart is the rates from 3 months to 30 years, including LAIF. It actually is in the council agenda report as well. It shows from 12/31 to 3/31 all of the different treasury rates. You'll notice that they have all increased, as I mentioned earlier. The biggest increases in the 3-year of 41 basis points, but the 2 and 4-year are just behind that at 38 basis points and 39 basis points. I wanted to point out also the LAIF rate. We're seeing a real significant increase in the LAIF rate over the last 12 months. Just in the last quarter, it's up 31 basis points. The Local Agency Investment Fund, that's what LAIF stands for, and it's held by the state. They generally invest in maturities of less, really short-term maturities. I think their average maturity is less than 200 days. And the city can invest with LAIF, can transfer money. It's considered liquid funds because we can pull on it same day. So we consider it liquid funds because we can pull from LAIF and use it for cash needs. It's invested with the state. It's guaranteed by the state. So it's very secure, safe funds, and they're considered liquid. So moving on to the city's investment strategy and approach, we do have 3 primary objectives, and they're listed here in the order of priority. Safety is always our primary objective, to preserve the principal. Next is liquidity. We need to meet the cash needs of the city. And lastly is yield, trying to earn a fair rate of return. We buy into the market. We don't chase the yields. We don't try to predict what the market's going to do. Our goal is to attempt to maintain a steady maturity over a 5-year period. We do that because we don't want to have a lot of cash on hand at any one time so that we have to invest heavily into a bad interest rate environment. It also makes sure that we have adequate liquidity over any period of time so that we can meet all of the needs of the city, any project needs, anything like that. Moving on to some long-term trends and benchmark rates. This graph actually shows 3 different rates. It shows the portfolio rate, which is in blue, the 2-year treasury rate, which is in red, and the LAIF rate. And why this is important is because it's actually an indicator of the city's performance. The portfolio rate should trend with both of these benchmarks, which is the 2-year treasury and the LAIF rate. So this is a long-term trend over about 18 years, and you'll see that the portfolio rate is trending with the 2-year and the LAIF, though there's a couple things I wanted to point out. There's always going to be a timing difference. As I mentioned earlier, that because we do a 5-year maturity ladder, it does take time for our investments to mature before we can invest back into the market. What that means is that when there are significant increases in the interest rates, we will fall slightly behind that with our rate as we invest back into the market. On the opposite side of that, when the interest rates fall, we tend to perform better than those rates because we still are holding investments that have higher rates as the interest rates fall. So what this also tells us is that if we were to deviate significantly from either of these trends, from the 2-year or the LAIF rate, then we need to look at that. Then something's off and we need to investigate that further. But right now, the 2-year, you'll notice, has significantly increased over the last year. The LAIF is also increasing, and the portfolio rate is increasing, but not at quite the same rate because there is that time lag. About a year ago, I started adding this chart. I thought it was helpful to see what Treasury yields were doing right before I came to present to you, just to see if we were to buy into the market this week, what would we be getting for our investments. So this is the Treasury yield as of last Thursday on April 19th. And there's a couple of things I wanted to point out here. The first being that all of the yields are up since March 31st. The second is that we call it the yield curve, which is basically just the the yield between the LAIF rate all the way to the 5-year, it's very flat. In the past, it's been a much steeper trajectory. And so what that means is that from about the 2-year to the 5-year, there is not a significant gain in investment yield between the 2-year and the 5-year. What this means is that it may not be as advantageous, or it is not as advantageous, to invest in a 4 or 5-year as it used to be. So we might want to look more into the 2 to 3-year range because we're not gaining as many basis points as we may have in the past by going further out. As we've said that we have 3 priorities, yield is our 3rd priority. It's more important to preserve principal, to meet the liquidity needs of the city. We do a 5-year maturity ladder. But that being said, if we have a 2-year hole in our maturity ladder or a 5-year hole, we might look to fill that 2-year because we're not gaining a lot on the 5-year like we used to. I thought it might be helpful to look at what the Treasury yield curve was a year ago to see how the steepness of the curve has changed. So this is the yield curve a year ago, April 24, 2017, and you can see how it was a much steeper curve a year ago, and that difference between a 2-year and 5-year was 57 basis points last year, whereas this year it's only 33 points. And there was a much smaller margin last year with rates being lower, and it was a much bigger difference between a 2-year and a 5-year. So I just wanted to show you how things have really changed in the last year. So the next area I'm covering is just the quarter performance for March 31st. We've mentioned that the portfolio yield has increased this quarter. It has increased from 1.529 at December 31st to 1.685%. Total interest earned during the quarter is $744,000, which is up about $136,000 over last quarter, and that is due to reinvesting into higher earning investments. The general fund portion is about $165,000. The total portfolio is up about $12 million since last quarter, from $180 million to $192 million. This is pretty significant for our portfolio. In the past, we generally were in the 165 to 175 range, so we do have a higher portfolio balance this year than we have in the past. The big change from December to March is primarily property taxes. We received a distribution of property taxes of about $13 million in January. This is a chart of our activity for the quarter. We have $12 million in purchases for the quarter, 10 of them being callable securities and $2 million being bullet. We buy in $2 million increments, so we had 5 purchases of callable and 1 purchase of a bullet security. We had no investments called. Since interest rates are going up, we rarely have investments called anymore. We had 2 maturities, a federal agency security and a corporate term note was matured. So in total, we had $8 million net activity, and basically what that means is we pulled $8 million from our liquid balance to actually make investment purchases in the quarter. This next chart is a summary of our investment portfolio at March 31st, 2018. As I mentioned before, we have about $192 million in our portfolio. We have what we call our liquid balance is our checking account and our LAIF balance. In total, about $74 million. Compared to December, it is up about $4 million. And we have about $20 million in LAIF right now we have set aside to make a CalPERS prepayment that we make every July. It goes up a little bit every year. Last year, the payment was $18 million. It's going to be around $20 million this year. So that's why we have $60 million sitting with LAIF right now. We have in our federal agency issues, those securities are up about $10 million compared to prior quarter, and our corporates are down $2 million. So that represents the changes in our purchases and maturities for the quarter. I'm sorry? So the CalPERS, Mr. Samaro just wanted me to explain a little bit about the CalPERS prepayment. So CalPERS has offered us the opportunity to make a portion of our CalPERS payments, a prepayment in July, and has offered us a discount in order to do that. Last year, we were offered a $650,000 discount to make a $18 million prepayment, and we would only have achieved about $250,000 in interest earnings. So it was a significant savings to make the prepayment. This year, the prepayment is about $20 million, and I believe the discount is a little over $700,000, and we will not be able to earn that in interest earnings. So we are making the prepayment. That's why we set it aside in LAIF to make that prepayment in July. This is the same information as I just presented on the prior slide. It's just in a pie chart format. So this is our portfolio as of March 31st, 2018. We have 54% of our portfolio in agency securities, and those are comprised of different types of agency securities. And then we have 39% in what we call our liquid balance, 8% in our checking account, 31% in LAIF. That will go down as of July 1st when we make that $20 million CalPERS payment. And then we have 1% in CDs, 1% treasuries, 3% in corporates. We have 3 corporates right now, and 2% in our airport note. And I did want to mention we have already made 2 purchases since the end of March. We have purchased a corporate note, and we've also made another agency purchase. We had 1 maturity, so we reinvested that maturity, and then we used some of checking account funds to make the corporate purchase. And so I'll be going over those at the next report. But I just wanted to mention we have made some additional purchases. So this just shows how we're diversified. So it's not just the types of investments, but also within those categories, we're also diversified. And so lastly, I'm just looking to ask that we are recommending that the Finance Committee recommend that Council accept and approve the third quarter investment report and the fiscal agent report that is attached to the Council agenda report for fiscal year 2018. And I think Mr. Samario also wanted... Go ahead. Okay. We'll wait for the recommended action.
Any questions for Ms. Nemes? Councilmember Dominguez?
No questions, but I'm willing to make the motion unless either of you have questions.
Any questions? No.
I move.
Actually, I did have one question. Let me see if I remember this. So out of the total portfolio, 97% of our investments are in agencies or short-term checking accounts. Only 3% are corporate notes. Is that right?
We have 3% corporate, 2% airport, and then another 2% CDs or treasuries. So we have 39, 90, 93%.
93%
yes.
are in government agency or short-term investments. I think it raises the question of whether or not we need to continue to do Finance Committee quarterly investment report presentations. And I know that there are other members of the committee that might be interested in shrinking that time commitment and having this just at council, perhaps.
Yeah. So just committee members, just Bob Samario, Finance Director, just to give you some context. So historically, we come to the Finance Committee on a quarterly basis. Every month, we're required to submit to City Council an investment report, so we do that. But basically, 9 out of those 12 months, it goes on a consent item to Council. So we used to do the same with our interim financial statements. We always have to do something monthly to Council, but on a quarterly basis, we'd come to Finance Committee. We've shifted to only twice a year with that. We do a mid-year report to Finance Committee and Council, and then a year-end report. We could consider something like that. It's pretty pro forma what we do. Everything we do, we don't deviate from what you hear every quarter. We think it's important that the committee hear what we're doing. It's really a sort of a check and balance. We used to do a lot more a number of years ago. We used to have an investment advisor that would come to you and independently review our investment performance and what we did and report to the Finance Committee and Council. So that's right on the heels of the Orange County bankruptcy. So it's really up to the Finance Committee as to how you want to proceed. We can do twice a year, continue on the same path, or less than that. It's up to you.
Okay. Anybody else have any thoughts? Councilmember Dominguez?
I think once or twice a year, at a less granular level, it's good to have these granular details, and maybe you can combine these in an annual report. But maybe give us more of a big picture how we're doing compared to other agencies. Giving a summary of any changes in our policy towards which corporate notes we're looking at. So, because we will look at it if it's in the regular council agenda, and we can pull it at that meeting if there's something that we're concerned about or there's any red flags. But I think in terms of this granular detail, it's fine probably if it's just in the consent report, and then giving us more of a big picture, what's changed year to year is probably something that Finance Committee would be pleased to look at and discuss.
Councilmember Friedman?
Yeah, no, I support going to, I guess, twice a year. I agree with what Councilmember Dominguez said. The one caveat would be when we have a new council member that comes on, it is helpful. This is the first time I've gone through this, so it is helpful just that first time. So other than that, I think what Councilmember Dominguez proposes is fine.
So do we want a motion to that effect
just-
or just direction?
Well, and for clarification, so every quarter, the agenda report is more detailed. We could continue to do on a quarterly basis a more detailed narrative in the agenda report, but still make it a consent item. So at least you
Yes.
have some of that discussion on the economic outlook and all that. So we can continue doing that and then come here in February, or, in mid-year and the end of year.
Yeah, I think that's really helpful. And the reports are very dense and valuable and interesting. But I don't know if we need to have the presentation here at the Finance Committee in addition to that.
Right. Okay. And then one last thing, I just wanted to let you know that Ms. Nemes will be leaving the city in about 2 months. Really, sad thing to see her go, but, this is important for her. And so we'll be looking to fill her position in the next few months. So I just wanted to announce that.
Well, congratulations to you. You'll be sorely missed. You've been a valuable member of the city's finance team for a long time.
Absolutely.
Yeah, thank you for patiently answering all of our questions and explaining sometimes Byzantine accounting and municipal finance things in simple layman's terms so everyone can understand. Really appreciated.
Thank you all very much.
So maybe back to the recommendation up here from the committee.
I would move the staff recommendation.
I'll second.
Motion's been made and second. Any comment? All those in favor say aye.
Aye.
Oppose and abstain. Matter carries unanimously. And we are adjourned.
Thank you.